The FOMC also provided additional guidance on future short-term interest rates, stating that it expects to maintain the federal funds target in its current near-zero range well past the time that the unemployment rate falls below 6.5%, especially if projected inflation continues to run below 2%.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the question is will the stock market panic sell-off continue, and have we started the Great Recession? Today, you guys, we're going to go over all of the important details as to what's happening in the stock market, what's happening in the real estate market, and what's happening with residential mortgage rates and the federal funds rate. And not only that, guys, after I give you guys a very quick breakdown of the market, which should last you this entire week, I'm also going to tell you guys a story, and we're going to remember where we came from by taking a look at videos from 2007, 8, and 9, listening to Ben Bernanke, like we already have, and President George Bush. We're also going to dig into the Siam rule of unemployment that is suggesting that we are 100% guaranteed to enter a recession. However, some people say it's actually going to be a Great Depression. I don't know about you guys, but I have already decided to stand out of the way when it comes to investing in any market. I've already liquidated all of my stocks. I put my money into safe assets like treasuries. This video is being made prior to market open on Monday. Now, I anticipate that this entire week is going to be an absolute bloodbath. But here we are with Bitcoin. Now, as of the recording right now, Bitcoin is down roughly almost double digits at 9.33%, settling at $52,715. So it's no doubt that, again, all asset classes right now, including home values, are plunging. I'm stepping out of the way. Maybe you're not. Let me know what you're doing below. Let's dig into stocks a little bit as recession fears rattle the U.S. stock market. Now, the question that Market Watch is presenting is, can Wall Street's great rotation trade roll on? And I'm going to tell you guys right now, I don't think so. Fears of a looming U.S. recession spurred by a massive stock market sell-off last week as recent soft economic data triggered a move into safe haven assets. Investors wonder if now is the right time to snap up defensive sectors of the market if Wall Street's great rotation trade still rolls on. U.S. stocks tumbled across the board on Friday after a surprising, softer than expected July jobs report. But honestly, that wasn't softer than expected. If you've been following this channel, and you guys already know they're going to revise that data anyways, and it's going to be much worse. This fueled concerns the Federal Reserve's monetary tightening cycle might still lead to a recession. And now again, guys, there's been multiple indicators that we're going into recession. So hopefully over the last 2 years, you've been preparing for this. Because remember, guys, cash is king. While a batch of lackluster tech earnings also weighed on the market sentiment. Friday's stock market pullback plunged the tech-heavy NASDAQ composite 2.43% into correction, almost crash-like territory. Remember, you guys, what's going on right now. Very important you're understanding the indicators and also how overvalued the whole market is, which usually occurs when a security falls at least 10% but not more than 20% from a recent high. The S&P tumbled 2.1% last week, logged its largest 1 week point and percentage decline since early April. Not really good things happening in the stock market right now. In theory, investors seeking to protect their portfolios from an economic slowdown would consider rotating into stocks in the defensive corners of the market from mega cap technology names. Defensive stocks are usually expected to provide consistent dividends and stable earnings regardless of the state of the economy. But again, you guys, when the stock market crashes 20, 30, 40%, I don't care if a $1 dividend is there. It's still, in my opinion, I'm not a financial advisor, but I'm not going to invest in something that I know is about to crash and that it already is correcting. I'm not going to do it. Are you? What we saw in July was a rotation out of an overvalued tech stocks and into the broader market. But in the last couple of days, it's been rotating out of everything, not simply rotation out of the Magnificent Seven, said George Ball. The benefits of being in safer sectors are not that great, and the risk of still having exposure in the more volatile areas is greater. Now understand, you guys, I'm not a financial advisor. I don't play stocks. I sold about 1.5 years ago. Thank God I did, because those stocks I sold are down another 70%. But I will say, stepping back and looking from the outside, I have no idea why so many people still have trust and confidence in the markets with all of the fraud, corruption, deceit, and Federal Reserve manipulating the money. I just don't think it's good. Another thing that's happened is the unemployment rate, the trajectory of the unemployment rate has skyrocketed. As a result of that, the entire market has shifted their expectations on the federal funds rate. So let's hop into CME and let me tell you and show you how much the market has just adjusted their expectations on what the Federal Reserve is going to do next. Starting with CME, September's rate cut expectation. Now, here's what has really changed here. There's really no expectation now that they're not going to cut. So they are not pricing in no cuts anymore. Obviously, additional signs of a turbulent economy and the fact that it's probably going to need some stimulus to keep it propped up and from going into a great depression. But regardless, the market is saying a 21% chance of a quarter rate cut. But what's really crazy is the market is now doubling down on a 50 basis point rate cut, again signaling massive turmoil behind the scenes. Probably the bank's unrealized losses and also the commercial real estate meltdown that is still going on right now. Not to mention that the school districts are absolutely broke right now and insolvent. But regardless, that's September. Let me show you what the market is now anticipating for December. Shocking. The market now anticipating a 54% likelihood, or 54% of the market is expecting a total of 125 basis points in federal funds rate cuts. But I'm going to remind you guys that doesn't necessarily mean that residential mortgage rates are going to go down. However, they have been going down. What I am saying though is, remember, it takes mortgage-backed securities or quantitative easing to really drop mortgage rates. Now, moving on to residential mortgage rates. Again, this is prior to market open. More than likely what you're going to see is a change in residential mortgage rates. But right now, we're sitting at 6.4%. That's a 30-year fix on a conventional mortgage. Now, if you've been listening to me, you should know to shop your mortgage. If you usually go with the broker, you're going to get about 50 basis points lower than what you're seeing here, which means, you guys, residential mortgage rates right now are under 6%. But don't forget, when it comes to new homes, they've always been under 5%, at least in Houston. I could tell you Lennar has been offering rates in the mid 4% for over 2 years. And now here's the thing, you guys, I'm about to break the whole narrative that when interest rates go down, a massive flock of buyers are going to come back into the housing market. That's just not true, and we have the data now to support it. And what I mean is take a look at this year-over-year comparison data. Right now, when we compare interest rates year over year, we have lower interest rates by about 0.25%, or rather 26 basis points. That's year over year looking at the monthly average. We also are down when we look at the weekly average. I've highlighted in red the reason why I know that demand is not running off the sidelines, because even with interest rates lower, demand is in the gutter. Demand is still down double digits from being in the gutter already, guys. We're down 14% with mortgage applications, 14% with Redfin home buying demand, and 19% down as far as internet searches. Demand right now to purchase a house is in the gutter. And I'm going to tell you guys, if you're thinking about buying right now, in just my opinion, overall, you need to stop yourself. If you must buy in the next 6 months, probably the best time to buy is December to February. But overall, the housing market's horrible, and right now we have a trifecta of great things happening if you are on the sideline. Number one, prices are going down. Number two, interest rates are going down. And number three, inventory is skyrocketing. As of July 14th, when we look at the Redfin median 4-week rolling average of home prices, there's a clear indication right here that house prices are no longer going up on a nationwide level. We found this out on July 14th. In fact, in less than a month, home prices have gone down almost $4,000 in just 3 weeks. You can see that here on the chart. And the other interesting thing is remember, you guys, that's with the top end of the median still growing and the bottom end of the median not. So the median is tainted. We're looking at proprietary information, and still home prices are not only going down. As you can see here, home prices are plummeting. Two more things I want to mention before we jump into the whole story I've created for you guys in video form. I think you guys are going to love these videos, to be honest with you. But looking at the 10-year Treasury, right now we're down about 3 basis points. It's worth noting that earlier this morning, and right now, you guys, it's not even 4 a.m. I've got up early because I can't sleep. There's so much going on right now, and I've been behind on my videos, and I really apologize for that. And again, real quick, thank you to the Real Estate Mindset community for pushing the message. And don't forget, you guys, if you want to fight the corruption, if you want to fight the value fraud, don't forget, take 10 seconds and sign the petition in my description and join Mitch Wexler's lawsuit to stop this. Now, moving on over to the 10-year. Now, this is going to change throughout the day, but right now we're starting off down 3 basis points. Again, it's worth noting that this actually got under, guys, 3.7, and if you've been watching, you know that that 10-year or the longer end of the yields actually track mortgage interest rates. But we are seeing that margin narrow, which essentially means that even though that 10-year goes down, that doesn't necessarily mean as a home buyer you're going to get that reward, because a lot of those banks are going to hold on to that margin and that profit because they have to stay in business. Again, there's no mortgage-backed securities being purchased from the Fed. Ending us out here, guys, here's the 10 and the 2 inversion. It's going to be very interesting to see if we have an inversion this week. I want you to stop this video. I want you to comment below and let me know whether or not you think we're going to have an inversion this week. Right now, we're only 8 basis points from an inversion. Now, remember, you guys, generally we go uninverted and then we enter recession, job loss happens, and everything goes to heck. So we're about 8 basis points away. I think we're going to be uninverted in August, potentially, possibly this week. Let me know what you guys believe. Take a listen to some video because I want to remind you guys once again where we came from, because if you didn't go through the great financial crisis, you may have no idea what I'm talking about. In fact, most millennials have no idea what an overvalued house is and have no idea what unemployment is. Let's start here, you guys. I want to start by listening to George Bush. Okay, we're going to go back in time to 2007 Q2, where GDP growth was 3.4%. So right before total economic collapse, we have the president bragging about how great the economy is. And let me know if you see any similarities to what's happening today.
My economic advisors for joining me here in the cabinet today. We've had a wide-ranging discussion about a lot of aspects of our economy. You'd expect when our economy is strong and resilient and flexible.
So continue to take risks. Is that what we should do? I don't think so, because remember, when people continue to take risk, as I did back in 2007, a lot of those people lost absolutely everything. And the reason I played you guys that clip is because remember, you cannot trust the officials and you can't trust the bulls. The bulls will always lead you into destruction as long as they make a commission off of your bad purchasing decisions. September of 2009, and let's listen to Ben Bernanke basically talk about shadow banking and how it's the end of any type of issues like that. Here's the thing, you guys, Basel III is still not even enforced. These regional banks right now, whether it be unrealized business losses or commercial real estate, are suffering. We've already had bank runs. And so listen to what this guy is saying. In fact, what I'm saying is they never finished the job.
Clearly, the shadow banking system has been a very big part of our credit system for a long time. And the contraction in that shadow banking system has been at least as important, if not more important, than the problems in the banking system in creating the problems with credit availability that we currently have. I imagine that the shadow banking system, at least in the medium term, will not return to the size it was before. The changes in accounting standards and regulatory standards will reduce the benefits to off-balance sheet type of lending by banks. Certainly, there will be new looks at the kinds of securitizations that take place. I don't expect to see highly complex structured credit products becoming a major source of funding in the near term. But on the other hand, there are a lot of securitizations that have proved their viability, mostly plain vanilla securitizations of various types in consumer products, consumer lending, student loans.
Student loans? Student loans? Is that a good asset right now? They stopped payments on student loans. We can't trust anyone. Now, here's the thing, you guys. Massive panic, massive sell-off, massive concern. Although I've been concerned for the last 2 years, the market's starting to wake up because a massive indicator called the Somme rule has been triggered. essentially meaning that we are 100% likely to go into recession. So I figured let's actually listen to what Claudia Sahm says about her own indicator. And I want you guys to pay attention. Look at how she's trying to talk down her own indicator and say, hey, the Fed needs to cut interest rates right now. They're not paying attention to unemployment. Take a listen.
Just interested, why did you create the SOM rule in the first place? What was sort of the motivator there? And to the extent that it has worked, that it's reliable, can you quantify that, Claudia, for us? What's the batting average there?
I did not get in this business to pontificate about recessions and if they were here or coming. The reason the indicator exists is I had a policy proposal to start fiscal stimulus, send out stimulus checks in particular as soon as a recession hits. So have kind of that frontline defense against recessions to help people and get it tied to economic conditions so it just goes out the door when it's time. And that was the reason, and that's why it needed to be simple. Wants to be in legislation, and it needs to be highly reliable because it was to help drive policy. And it was designed for fiscal policy, which can act very quickly. Having it in a discussion about what should the Fed do, is it time to cut interest rates, that's not what that tool is thinking about, because Fed policy interest rates, they take more time to work. Right? You would never, if I were to design an indicator for the Fed, it would not be one like the SOM rule because it's much more in the moment.
So Claudia, to be clear, you think the Fed should start cutting in September, right? You don't think they should wait for the SOM rule to be triggered?
I think the Fed has a very good case to begin a gradual reduction in interest rates based on the path of inflation itself. That we have made a lot of progress, and you want to be able to do this gradually. And the Fed should be out of the way, so to speak, by the time we get to the 2% target. And to me, it's very clear looking at the data, looking through a lot of the noise that we had at the beginning of this year, that where we are headed. And we want to do this gradually. And I think the risks are building, particularly now that the labor market has showed some. Then the labor market has, quote unquote, normalized. Like, we're really kind of back to where we were before the pandemic, which was a very good place for the labor market. And inflation has not totally, but largely normalized. It's made a lot of progress to 2%. The one thing that has not begun to normalize is the federal funds rate. So, getting all of that synced up together is the Fed's next challenge. And given what we know now, it's appropriate for the Federal Reserve to get going.
Now, for some of the millennials that don't remember how bad the job market was back in the GFC, I have this clip here that is telling us that we lost 2.6 million jobs in 2008. And again, I want you to really listen to this and see if you can spot any of the similarities in the video I'm about to play as compared to what's happening right now. I think you guys are going to be shocked.
The economy last year, that's the greatest decline since 1945.
If we measure how the economy is doing on the basis of employment, it's doing about as poorly as you can imagine.
And as bad as the unemployment number is, it only tells part of the story. The so-called underemployment rate, which counts part-time workers and those who've given up looking for a job, rose to a record 13.5%. And the average work week has fallen to just over 33 hours. That's a record low. In Iowa, the Pella Window Company decided to cut hours instead of jobs. With the housing market in a state of collapse, Pella's just put some employees on a 4-day work week.
We have about 3,900 of our roughly 9,000 employees that are going to this 4-day work week for January through March.
Workers like Stephen Glick saw it coming.
It's already affected me. My wife and I don't run to Des Moines to go to the mall every day or every other week.
The country's largest trucking company, Kansas-based YRC Worldwide, took another road, asking its employees to take a 10% pay cut.
Did you vote yes?
Yes, I did.
New York driver Eddie Poger and YRC's 40,000 Teamsters approved the pay cut last night. Poger says it'll take more than $100 out of his weekly paycheck.
So you're taking a cut to keep your job?
To keep my job. To keep my job and support my family and to keep my health benefits and to make sure I have a pension when I retire.
The unemployment rate, many economists say, could still be headed sharply higher, at least until the Obama administration's massive stimulus package kicks in.
The real question is it big enough? Is it going to work? Nobody knows the answer to that question.
You better start working on your resume, and if you don't know what a resume is, tap it in Chat GPT and figure it out. It's something that's really important. Here's a pretty wild video from 2010. Someone talking to Ben Bernanke about why was the GFC so harmful. This is so crazy. Take a listen to this.
The failure of economists to foresee how deep the recession would be once the housing bubble burst. And your paper really focuses on the latter one. So what do we know about why it was so hard to foresee the depth of the recession? I mean, after all, it was in the spring of 2008, forecasters at the Fed and elsewhere were predicting a recession, but not one nearly as deep as the one that followed.
No, that's right. There was really two forecasting errors made. One was identifying the crisis itself. Many people saw aspects of it coming. Robert Shiller talked about the housing bubble. Alan Greenspan talked about risk-taking. But nobody saw how widespread and devastating the crisis itself would be in terms of financial markets and financial institutions. But the second forecasting error, one you were alluding to, is the effect of that crisis on the broader economy. And now there was a lot of reason to be worried about that. And policymakers, including many of us at the Federal Reserve, were quite worried about it. We knew from history, the Great Depression, for example, where I'd done a lot of my academic research, was a situation where the collapse of financial markets was a major contributor to the depth of the Depression. Likewise, we know that historically, big financial crises are often followed by long and deep recessions. But that being said, the formal models that we were using at the Federal Reserve and other forecasters were using did not pick up the depth of that reaction. So to give you an example, the Fed staff, which are the best, really the best macro forecasters around, even after the crisis was getting into its worst stages, saw unemployment rising only to say 7%, when in fact we know that in 2009 unemployment hit 10%. So they were underestimating how bad the impact of the crisis on the economy was going to be.
When I listen to something like that, to me, it makes me realize that everyone is always wrong right before a recession, except for the bears. That's it. We're the only ones that are right. In fact, I've only been bearish for 2 years. I've been bullish the whole time. I've only been bearish for 2 years. I've lost a ton of money doing the right thing, and I am proud of myself for it. Nevertheless, think about what he said. The own White House advisors were underestimating everything. Isn't that what's going on today? Now, here's where I want to end. Take a listen to this young child complaining about working 9 to 5.
I have never felt this much dread in my life before. Like something inside of me died. And honestly, if I keep working 9 to 5, I think I'd rather kill myself.
In other words, y'all, do not have that mentality or that mindset. And I'm going to tell you guys, when I was younger, okay, when I was in my early 20s, I used to work 12 hours a day, Monday through Sunday, and I was motivated to do so because I wanted to get ahead in life. Now, that attitude got me far, which ultimately amounted to my utter destruction because I failed to adapt and I failed to change. And here's where I want to end you guys. Remember, I lost everything. I had a bankruptcy, foreclosure, and repo. Fast forward to today, I have great credit. I'm on the sideline waiting to purchase my primary residence. But if I would have just changed my spending habits 6 months before I lost everything, I would probably be a multimillionaire right now. In other words, you guys, it's not too late. Do not give up hope. Happy Monday. I hope you have a great week. I suspect this may be one for the record books. Other than that, guys, if you're out there investing in real estate, you guys already know I wish you luck, and I hope you win.